let's get started. Okay, well, good evening, everyone. Welcome. I am Yvonne Schwab, ACG Silicon Valley CEO. So happy New Year to everyone that I haven't said it to yet. I'm excited to present you today's event, Capital Markets Outlook for 2021, in collaboration with BNY Mellon. For those of you new to ACG Silicon Valley, we are the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. ACG is a worldwide organization offering an array of networking opportunities. With almost 15,000 members in 59 chapters across the world, ACG provides local connections with a global reach. If you haven't had a chance, check out our new ACGSV web experience. For the past few months, we have worked tirelessly to update our webpage. With the help of Aloha Cloud, we now have a wonderful new web experience we can offer to our ACG community. So give it a go when you can. ACG Silicon Valley is offering a variety of virtual events in the coming months. We invite you to visit our website, acgsv.org, to see the full calendar. Next Tuesday, on January 26th, we have our C-Circle Economic Outlook. Then we have the M&A Circle, How Software and Technology M&A Survived. In February, RSM is sponsoring an event on how 2020 changed e-commerce strategy forever. We're really excited to have an event in collaboration with Santa Clara University on gender and racial bias in venture capital. We also have our round robin networking event with the San Francisco chapter and a Zoom makeover, up-level your online screen experience. We thought we'd give something else a try. So now we're excited to offer you today's event, which would not have been possible without our sponsor, BNY Mellon. Special gratitude for the little surprise we all received in the mail. Hope you can see that. Super excited. I now would like to introduce you to our moderator today, Mark Jameson, a senior director with BNY Mellon Wealth Management. He's an expert in guiding successful entrepreneurs and wealthy families through strategic and financial exits of their privately held companies, with significant experience regarding liquidation events, mergers and acquisitions, and exit strategies. Now, without further ado, I give you Mark.
Well, thank you, Yvonne. And I echo Yvonne's thoughts. Happy New Year to everybody. Here's to a amazing 2021. So the goal of today's panel is to provide an interesting perspective on the capital markets from industry leaders that cover venture capital, private equity, M&A advisory, and investing, given the dynamics of today's market. But before we begin the program, as the sponsors of today's event, BNY Mellon sent all those who registered by the deadline a special gift that we'll discuss here in a moment. To tell you more about the gift, I'd like to introduce one of our key partners during this pandemic, Gary Fish. Gary is the owner of Gary's Wine and Marketplace, and in early 2020, Gary immediately evolved his practice to deliver a wine experience in a COVID world. Gary and his team helped us with numerous virtual wine events throughout the year with our key partners and clients, and that created some lasting memories and special connections. For those of you who don't know about Gary's Wine and Marketplace, it began as a small wine shop in Madison, New Jersey in 1987, and has now grown to be one of the finest wine businesses in New York metropolitan area, with 4 stores in New Jersey and a 5th store in Napa, California. If you've ever worked with Gary's team in the past, you know that they have made a commitment to friendly, attentive service by his expert wine team, and that really sets Gary's offering apart from the other wine merchants. So Gary, if you wouldn't mind, can you tell us a little bit more about the special sponsor gift today and why you selected this for ACG Silicon Valley?
Sure, Mark. Thank you very much for that great intro. You made me sound, like we were a professional company. I like that a lot. Well, first, I also want to say Wow, my lights blinked. That got me nervous. Um, to a happy, healthy new year. I would actually clink with a glass of champagne, but they didn't send me a glass. And I just finished the Pinot Noir tasting. So we'll cheers in my world to Pinot Noir. And I have a question before I get too far into it. Why do we clink glasses? Does anybody know why when you say cheers, you clink? Well, there's two schools of thought, and both are really viable. One is that by clinking, the evil demons hear that sound of the glass clinking, and they all run away. So the evil demons do not attack you that night. I find that a very viable option. The second one, which is probably more true than we know, is by clinking, there's a chance that your wine could spill into the person's glass who you're clinking with. And if you're worried about somebody trying to drug you or put some poison into your glass, by clinking protects you from that. So now next time somebody goes to clink with you, you'll know that there are very, very important reasons why they're clinking. When I think of bubbles, and I say bubbles because really when we talk champagne, it's only from the Champagne region of France. The rest of the world, Prosecco are fun bubbles made in Italy. Here we're tasting a California sparkling wine made just like champagne. So it's method champenois, but it's made in California. The reason I picked Paula Cornell champagne, I said Paula Cornell sparkling wine from California is because of Paula. Paula's second generation Napa Valley winemaker. Her father, Hans Cornell, came to the United States from Germany. He was in the concentration camp, and he was a political prisoner, not for religious reasons. And his family bribed to get him out. And he had one day to leave Germany. And he ended up in England and then Ohio and then California, where he met a woman, fell in love, moved to Napa Valley and started doing what his family was doing in Germany, making sparkling wine out of German grape varietals, Riesling, Gewürztraminer. And it was Hans Cornell champagne, or I think they called it champagne. Hans Cornell, and it was made in Sonoma and Napa. And he was doing very well until the late 60s and early 70s when the French company Domaine Chandon, Moet Hennessy, opened up a winery called Domaine Chandon, and Domaine Mum opened. And so he was competing against two big companies, and he went out of business. Paula Cornell, his daughter, had been working in the family business since she was probably 5. As she describes it, she got her pigtails caught in the bottling line one year. And when her father closed up, Robert Mondavi offered her a job. And she worked with Robert Mondavi for years, and then went and worked for a bunch of other Napa Valley wineries before she went into the consulting business. And we've been friends forever. And we've been talking about going back into the bubble business and creating something on her own. And about 3 years ago, she came to me and she said, Gary, I'm going to do it. I'm going to make bubbles. And I said, what are you going to call it? And I wasn't sure if she was going to use her name or not. She said, Paula Cornell. And I almost cried, because here it's full circle. It was a family business that was thriving and couldn't adjust to the time, which is really appropriate for the conversation today. And she chose to go back into the business with the lessons she learned from her father, the business lessons and the connections she's made over the years, and create a new product. And we were fortunate enough to taste it in her kitchen last year before the final bottling. And when you taste with Paula Cornell in her kitchen, I want to describe the setting. It's a house built probably in the early 1900s, just in St. Helena, but just north of St. Helena. It's got 2 small bedrooms and a beautiful but small kitchen. In the kitchen, she lined up the different bubbles that we were going to taste. Underneath the kitchen table was 2 chickens because she has chickens and she lets them roam around the house, and 3 dogs. And that's Paula's world. She loves pets, she loves people, and it became like a conversation. The dog whimpering, the chicken chirping or whatever chickens do, and us smelling and tasting her bubbles. And then when it was finally released, and I tasted the final product, which you have in front of you, I fell in love with it instantly. Not only did I fall in love with it, but Wine Enthusiast gave it 94 points, Editor's Choice, which is very high for a California sparkling wine. The Wine Spectator gave it 90 points. And it's a tribute to a person who, for her whole life, for the last 30 plus years, have been helping other people market and sell their wines, to go back to her roots, to her family, to her tradition of making bubbles and create something so good. And how does it, how do you do that? Obviously, she's got the connections, and she chose to pick only farmers that were growing sustainable grapes. So all of the grapes are from sustainable vineyards. They're all the vineyards are multiple generation. I think one of the vineyards is 5th generation. So it's a tribute to her respecting her roots and the roots of the people around her. And then it's a blend of Chardonnay, 80% Chardonnay and 20% Pinot Noir. If you taste French champagne, many of them are Pinot Noir, Pinot Meunier blends with a little Chardonnay. If it is 100% Chardonnay, it says Blanc de Blanc on the label, white of white. Pinot Meunier is a red grape, Pinot Noir is a red grape, and they just take the skin off when they're making the champagne. So she chose 80% Chardonnay because it grows very well in Central California, where she's getting most of the fruit. And Chardonnay is elegant and crisp and dry and good acidity. And the Pinot Noir is richer and gives more backbone and a vibrance. So it comes off with great acidity, great fruit, great balance. And at the price point, it's delicious. And for $22, can't beat it. It is unbelievable. And when I think of champagne, when I think of bubbles, and I think of sparkling wine, I think of celebrations first. And we are definitely in a time of celebratory period, right? Whatever you think about what's been going on, there is a vaccine coming. The election is over and we have a new president. Whatever your opinion on the subject is, it's new, it's change, and it's a new year. And for all those things, I'm thankful. And I think that now's the time to celebrate. And there's no better time than with some bubbles. Far be it from me to forget chocolate. We also sent a package of truffles in your package. And this I had to get a cheat sheet for. The bubbles I know. You have a dark chocolate Cabernet truffle. You have a milk chocolate Cabernet truffle. I suggest if you haven't eaten them already, that would be great. Taste the bubbles and then take a little bite of the chocolate, the dark chocolate. Taste the bubbles, take the milk chocolate. Then you have the brandy Gold Rush and the dark salted caramel. That's my favorite. I like in chocolate, I like that sweetness that you get, and then the saltiness of that to me is just delicious. And it's a great accompaniment to bubbles. But also, when you think about pivoting, which is what we did, and you think about the chocolate business, they've gone into heavily working with us and other people on creating events and tastings. So it's fun to do. You could try it with the bubbles, without. I'm good either way, just as long as you try it. And I think I was on a very strict time limit, and I think I'm right in the money. Does anybody have any questions? Mark, do you want to? It's all you.
No, Gary, thank you so much for that great overview. And I took some copious notes with regard to champagne. We'll be ordering some more. I assume we can go to Gary's marketplace and place the order, no problem.
Gary'sWine.com. We're here for you.
All right, well, perfect. Well, thank you so much. Happy New Year to you, Gary. I'm sure we'll be virtually seeing you at least in the first half of this year. So Happy New Year to you. Thanks for all your support. Really appreciate your partnership.
Happy New Year. And if I ever decide to sell, I'm calling you first.
Thank you very much. I appreciate that.
Happy New Year, everybody. Take care. Thank you.
So I hope everybody enjoyed the champagne and chocolates, and you've had a chance, hopefully with the extras, if there are any extras, you can share those with your family and loved ones. So before we begin the formal event, just a quick housekeeping item. We will be leveraging the ask a question or the Q&A button today on Zoom, right there in the middle Q&A. So I'll be monitoring the Q&A and we'll be asking the panelists some of the live questions that we're getting from the audience. So first, let me introduce our panelists. So today's webcast offers a timely panel discussion featuring experts from the Bay Area. Our featured speakers joining us today are Mihir Jabalia, Managing Director, Technology Investment Banking with KPMG. Roger Royce. Roger is a partner with international corporate law firm Haynes & Boone, LLP. And Yale Kaufman, Managing Director and Family Investment Advisor with BNY Mellon Wealth Management. So first question, and I'm going to ask each one of the panelists to take some time, introduce themselves and their practice. But we know that deal makers in 2021 will be operating against a backdrop of continued uncertainty as the pandemic continues, the COVID-19 vaccine rollout begins, and the Biden administration takes office. So I'm hoping that each one of you can tell us again more about your practice and your outlook for 2021 and what major initiatives your firm has put in place to support this perspective. So we're going to start with Mihir, then Roger, and then finish with you. So Mihir, if you can take it over from here.
Okay, great. Thanks, Mark. Good evening, everyone. My name is Mihir Jabalia. I'm a managing director and co-head of the Technology Investment Banking Group at KPMG. I'm based in Silicon Valley, and sort of a quick thumbnail on our practice. We are the most active advisor globally in the middle market in M&A and private placements. So in the last 5 years, we have closed 2,800 plus deals, all in the middle market. These are M&A deals, 50 to 500 million. And we also do private placements, generally 15 to 200 million. We're organized by sector. So I co-lead our technology sector. We have bankers who cover other sectors like healthcare, financial services, industrials, etc. We mimic the various sectors in the GDP. I've been at KPMG for 9 years. I've been a banker for 22 plus years, all in tech. So going back to your question, Mark, regarding outlook for 2021, I think we have gone through a pretty remarkable year in 2020. In March and April, there was extreme fear in the market. People didn't know how bad things would get. And from there, things have rebounded quite nicely overall in the M&A business, as well as raising capital. I think part of it is we still do have a lot of pain in the economy. We still have unemployment at about 6.7%. But people generally, and if you look at the public markets have come back pretty strongly since sort of a low point in March. And if you look at public indices, the S&P, the NASDAQ, the Dow, they're all kind of hovering around record levels. So I think fundamentally, people feel like we are moving towards an environment where the fundamentals of the economy will be better in 2021 compared to where we were in 2020. You have the vaccine is people will get vaccinated, and as that happens, it's going to have an impact on things getting back to kind of where they were. I think you still have GDP growth sort of in this year kind of forecasted at 4.2%, which is better than last year. And if you look at the overall market, I mean, I think you fundamentally have public companies, boards as well as management teams feeling much better about their stock prices. And as a result, they're going to be more likely to do M&A compared to where they were in March 2020. So if you look at stock prices that are at record levels, public sentiment is improving and moving up and to the right. We have a environment where interest rates are still pretty low, and they will likely move up as we get later into this year. And lastly, I would say there is a fair amount of shareholder activism where public shareholders want to see managements and boards either use the capital or dividend it back to shareholders. So if you look at all those scenarios, it kind of points to, we have seen a significant pickup in activity level in terms of M&A since June of last year, and that we think that 2021 will be a better year than where we were in 2020. So those are probably my high-level comments, Mark, in terms of where our observations on what we're seeing in the market.
Thank you, Mihir. Roger, love to get your perspective as well.
Okay, well, first of all, thank you for inviting me to be here, Mark, and appreciate the opportunity. And it's always good to talk about the future. So, as you mentioned, I'm a partner with the law firm of Haynes and Boone. I'm theoretically resident in the Palo Alto office. I haven't seen it, but they tell me it's nice. Here in Silicon Valley, and I'm in the emerging growth and venture capital practice. Mostly because of where I am, I suppose, but that is a big part of what I do. I work with technology startups and the funds, mostly venture funds that invest in them. So I think your question here, you're asking about my view of the outlook for 2021 and what major initiatives our firm put in place. I like to tell my VC clients that in some ways I'm as much of a VC as they are, in the sense that I have to bet on technologies and companies and industries. And if I'm right, I stay in business. Our firm, as an initiative last year, put together a COVID task force where we focused on all things COVID related, PPP loans, the tax credits, the forgiveness, the force majeure issues, litigation issues. This year, we were quick to jump in to another task force, a presidential transition task force. And believe you me, there is going to be a lot to talk about. There already is. We're only 2 days into this administration, and there's certainly a lot of things are being shaken up. Just today, Janet Yellen expressed her, let's just call it aversion to cryptocurrency, which came as kind of a surprise to me anyway. So that tells you that I think we're going to have a much different world in 2021, and we're going to be there at the front end to adapt to it. In terms of industries, though, let me just focus on three things. As you probably know, I do a lot in ag and food, ag tech and food tech, and that has been a powerful sector in 2020. A lot of activity, very strong, despite, in fact, maybe stronger in some areas. For example, farm-to-table and urban farming and localized farming. And that's something I'm still spending quite a bit of time with. It's probably one of the biggest things that I do is ag tech, agriculture technology. We also have a precision medicine digital health group at our firm that we're focusing on that area. That's an area that actually increased. In fact, Q3 of 2020 for VC investments, probably the biggest quarter health tech has ever had. And in fact, last year, the health tech industry as an investment sector for VC tripled in China, tripled. Women health tech in particular has been growing. So this is an area that's growing. We had a little bit of a dip in Q4, but it's still strong. It's a very strong sector. So I'm very, very excited about that. And we've got a big team kind of focused on that area. And the third thing, this might surprise you a little bit, but this is kind of from being on the ground at the front lines, and kind of people talk to me first before they do anything, is energy tech. We used to call it clean tech, then we call it climate tech, then we call it something else, but lately it's energy tech. That's a sector I'm really excited about. There's just much more activity. There's more people focusing on it. I'm seeing technologies that 10 years ago just couldn't get any traction. All of a sudden they're back and they're being funded. And I think they're going to do well this time around. So yeah, so we're gearing up for those particular sectors. And I think that 2021 is going to prove those three areas to be very big. So thanks again, Mark, Roger, Royce, Haynes, and Boone, and I think I'll turn it over to you.
So thanks, Roger. And that was surprising. Energy tech, I would have never predicted that. So Yale, if you could just tell us a little bit more about your role with BNY Mellon, and a little bit more about your outlook for 2021.
Sure. So thanks again, everybody, for joining us tonight. I guess Mark, it's just about a year since we held our last in-person event in the Menlo Park office, if I'm not mistaken.
That's correct. And if you remember, we actually had to add coronavirus as a last-minute agenda item, as it was just starting to become part of the conversation. So yeah, come a long way.
Seems like ages and ages ago. Yeah, so Yale Kaufman, I'm a managing director, and as Mark said, I've got this long title of Family Wealth Investment Advisor, but what that really means in layman's terms is I work very closely with Mark and others in our offices throughout the West Coast to really help create curated and bespoke investment designs for our clients. And those clients can be family offices, but for the last couple of years, I'd say Mark and I and others have really been heavily focused on the entrepreneurs, the business owners who are going through these transitions of selling companies and maybe starting another one. But there's definitely a transition in place going from the entrepreneur to the investor. And we helped create kind of a virtual office ecosystem around clients and families. So that's what I do. I've got decades of experience. I've used to manage as an institutional money manager for another firm in the Bay Area that's pretty well known. But I've been at BNY Mellon for about 6 years and thoroughly enjoy working with our colleagues, both internally and externally. So in terms of views, we'll get into, I've got some slides that we'll share a little bit, I think, Mark, as we get into the discussion tonight. But overall, I'd say that our view at BNY Mellon is a little bit more rosy, perhaps, than some others. We think that GDP could be as high as 5.5% this year if everything comes through as we expect. And Mihir mentioned something that I always find fascinating coming from his perspective, which is what's happening in the public markets and what's happening in the private markets. And indeed, the increase in M&A activity is not only good for private markets, it's also a really good sign for public markets as well. I think that is one of the reasons that we are a little bit more bullish than others for 2021 when it comes to equities, as an example. So I think I'll stop here, and then Mark, I'll turn it back to you.
Okay, thank you, Yale. And just a reminder to all the participants today, if you have any questions for our panelists, please leverage the Q&A function within Zoom. I'll be monitoring that throughout this panel. So look forward to your questions. So Roger, I had a question for you, and it sort of stems from the fact as you look at sort of the roller coaster of in the financial markets associated with the pandemic, risky assets have actually absolutely been on a tear since the start of November in 2020. And I think a lot of that is thanks to the fading of the uncertainty around the US election, and more importantly, news about the effective vaccines for COVID-19. So you mentioned you focused on venture capital and startups. I'm curious, who's receiving funds in this environment? How accessible is risk capital to the earliest of startups, and what are the other sources of risk capital at this seed level round today?
Yeah, I deal with the riskiest of capital, of course, startup space. Not many home runs, but also probably the highest returns. When they do hit, they hit big. Well, what the data shows is that last year seed finances have gone down a little bit. I have a theory about that, but actually the amount of money invested by VCs has stayed stable or gone up. So how could that be? Well, what we think is happening is that they're just putting more money into their existing portfolio companies and kind of propping up their existing investments rather than starting new ones. So seed money has been a little harder to come by in the venture community, or the early money in the VC community, Series A. And it kind of makes sense. I mean, if you're stuck at home and you're sheltering and you can't go to your great, awesome events, Mark, in person and meet people, it's going to be hard to get in front of these VCs and give them your elevator pitch. I guess you can do yet another Zoom call, but I think that might have something to do with the fact that early stage entrepreneurs are having more trouble getting that first money from the institutional investors. However, on the flip side of that, every year since the Jobs Act in 2012, I keep saying the same thing. I keep saying there's a tremendous amount of money out in the system, a tremendous amount. How could there possibly be more? And every year something happens that makes it more. So just recently, we have this thing called Reg CF. It's crowdfunding. It up until recently, it allowed companies to raise a little over $1 million over a 12-month period from pretty much almost anybody if they met a very small net worth, net income requirement. Whether they're accredited or not, provided they jump through a lot of hurdles. It's crowdfunding, crowd financing. Well, $1 million is, it's hard to justify the transactional cost for that. Well, the SEC has recently proposed amending, not so recent anymore, but they proposed amending that restriction to raise that $1 million to $5 million. Well, now it's pretty much worth doing. So I saw a lot of crowd financings last year. We're going to see a ton more in 2021. It's just so much more accessible and available, and we've had enough history with it now, and we've had an SEC that's been very friendly to crowd financings. Now that might change under Gary Gensler, I don't know, but the state of the law now is that's a source for some alternative financing. There's also an exemption called Reg A Plus. You used to be able to raise up to $50 million. The SEC proposed raising that to $75 million. It's like a mini IPO. I think, it's only a measly $25 million, I suppose, in the grand scheme of things, but I think it'll make a big difference in how many people want to use it, because Reg A Plus is a relatively expensive thing to do, at least in terms of legal fees. And then finally, I'll just leave it with this. This has definitely been the year of the SPACs. Everybody knows that. It's probably a reflection of our, I guess, antiquated public offering laws, but nevertheless, it's out there and it's back, and it's just like the reverse mergers of old. And I don't see any signs that that's going to stop. And again, unless the SEC changes its positions. So yeah, there's been a tremendous amount of money in the system, including alternative financing.
Okay, thank you. So taking it to a different perspective, Mihir, I know you work with more established companies, some that are even profitable and looking to IPO or potentially get acquired. I'm curious how the pandemic has sort of impacted the goals and behaviors of private equity and the strategics. And do you see both of these acquisitive in 2021? And with that said, how are you advising your private business owners moving forward?
Yeah, a great question. So I think you have an environment where private equity firms are sitting on over $1 trillion of dry powder. If you look back over the last 5 years, the funds have gotten much bigger and they're writing much bigger checks. So there is a lot of capital sitting on the sidelines with private equity firms. One little factoid, last year, of all the deals done by private equity firms, 70% were add-ons to their portfolio companies. So private equity firms are buying a platform company and creating a thesis around what types of companies can they go acquire in adjacent spaces to get more scale, and partnering with management teams to go do that. So, if you look back over a longer period, you would, if you were having this conversation 10 years ago, strategics would generally outbid private equity firms on every transaction. In the current environment, what we are seeing is there are a number of private equity firms who will outbid strategics. So that is a phenomenon that has certainly changed. There are a number of private equity firms who have a thesis of buying a platform company, and then once they buy a platform company, they act like a strategic and can move fast. And so private equity firms are certainly very active in all of our processes. With respect to the strategics, we are seeing strategics being definitely more active in M&A. We talked earlier about how the stock prices have moved up and to the right, the ability to raise capital in the public markets, as well as access to capital certainly helps strategics be more acquisitive. But also when you get on earnings calls of some of the large companies, you're seeing public investors ask management teams about how are they going to get growth. If they are growing by a modest amount, how are they going to, people are more focused on sort of growth versus profitability in this environment. So I think there's definitely strategics are being acquisitive in this market. Now, what has changed is what we saw in this period with acquisitions, both from strategics as well as private equity firms, a higher level of diligence on any type of acquisition that they're making. So for example, people didn't, before COVID hit, buyers would not be as focused on the underlying industry of the customers. So if your customers had exposure to hospitality or travel and leisure or restaurants, that industry certainly got dramatically impacted by COVID, and a lot of companies went out of business. So even if you had even a great product or a service in that industry, looking at the underlying sort of credit risk of customers became really important. So the other thing that has also changed has become a world of haves and have-nots. If there are companies which have any type of issue, whether it's customer concentration or revenue growth slowing down or margin degradation, they are seeing that they're not getting as much interest from buyers. But if you see that there are companies which have sort of a fundamentally a good underlying business, strong margins, a significant IP in the business, those businesses are definitely getting a lot of interest from both strategics as well as private equity firms. In most of our processes, we are going to both strategics and private equity firms. We are advising clients that you got to look at both options because, on one hand, strategics can pay good values, but at the same time, private equity firms can move fast. And they also have a number of portfolio companies which can act just like strategics. So to answer your question, Mark, we are generally going to both strategics and private equity firms in our M&A processes.
Thank you. So out of curiosity, I mean, if you had a crystal ball, I mean, what do you think the multiples are going to be? And I know you focus in software as a service. Where do you think multiples will be in 2021? And is that different than 2020?
I think there's no sort of one size fits all answer. I would say, multiples, I would say directionally will move slightly higher in 2021. Partly because of the public markets are likely to move in that direction. I think even when you look at sort of SaaS companies, they're trading at sort of record multiples. We've seen on acquisitions anywhere from 7 to 10 times ARR. I think but again, it's not a one size fits all. I think there are a number of sort of underlying metrics that you look at in the business in terms of what is the retention rate? What's the LTV to CAC ratio? There are sort of a lot of underlying metrics that you look at in the business, and companies which have sort of fundamental unit economics, they get sort of the upper end of those multiples versus others. So it's the short answer is there's not sort of one size fits all, but I would say directionally we are moving up and to the right on those multiples.
Okay. Well, thank you very much. So, given the runoffs results in Atlanta, the Democrats have reached the dreamed of trifecta, right? Gaining control of the White House, flipping the Senate, and maintaining the majority in the House. So, Yale, I'm curious from an investing perspective, how does this sort of change the landscape?
Well, if there are any surfers in attendance tonight with Mavericks just over the hill, this wasn't quite the big blue wave that I think the Democrats were hoping for, right? So the first initial reaction people had is, oh geez, now all the proposals from the Biden administration are going to be approved, and no, not so fast, my friend, right? It's very much split, and I think there's certain elements that probably have a higher probability of being passed, and others are probably not, are going to be much lower in terms of priority and then, of course, probability. Yvonne, if you could display the first content page, that would be helpful, because I think this will help, Mark, it'll help me kind of frame our thinking. If you can go to the next, there you go. It may be a little bit hard to see. These are the themes that we had developed for investment themes for 2021, which in all candor were developed before the election results in Georgia. It was kind of after the presidential election, but before we got into 2021. A couple of the bigger themes to bring to your attention are, the monetary and fiscal stimulus packages, right? Those are huge. Getting past COVID, right? Having the vaccines being rolled out effectively. Relatively low rates, kind of on the longer end. I think Mihir mentioned that before as well. And a weakening dollar relative to other major currencies kind of lead us to, plus there's the strength in the global economy. As all these things are starting to come through, we're starting to see economic numbers improve. So that's why we've got a pretty positive view on equities. But with that in mind, we're starting to shift things a bit. For the past few years, we were overweight to U.S. large cap stocks, because that was where we felt was the best kind of risk-adjusted return profile. Lo and behold, that was true. But over the last 6+ months, we've been slowly adjusting our investment allocations, and we've increased emerging markets, we've increased small cap, while at the same time reducing U.S. large cap. So I'd say the biggest change as a result of the Democrats winning both Senate seats in Georgia is that there is a little better likelihood of more stimulus packages coming through than had there been a Republican-controlled Senate, right? Because of that, we expect this continued kind of rotation of value stocks, kind of catching up with the growth stocks. We expect that to continue. A couple other areas that'll be impacted by the changes in administration are, as a result, a weakening dollar, because you're going to have strength in the emerging markets economies, you're having strength overseas, and at the same time we are issuing a lot of these packages here to help stimulate our economy. So all those things could potentially produce some inflation down the road. We don't see it as a big threat right now, but it's something that we're keeping an eye on, maybe later this year into next year. Mark, I mentioned that there may be certain aspects of legislation that are probably more likely to pass than not. So as an example, the easier one probably is to increase the income tax rate back up to the 39.6, where it was before Trump took office. We believe there's far less consensus around changing things such as carried interest, right, which is hugely impactful here in Silicon Valley, right? If we change the tax treatment on that to ordinary income, that would impact a lot of dollars and a lot of wallets. So I think, that being said, we still have to wait and see how this Congress works together and how some of these changes will be made. I'll give you one more minute. Yvonne, if you could turn to the next slide, I think it's important to share some context. So regardless of which kind of configuration you have, right, Mark, in Congress and in the White House, markets tend to be fairly positive. This slide shows you back to 1933, under various combinations, the average annual return. And the Democratic controlled Congress and White House, the average return has been 9.3. As my Aunt Elaine would tell me, that's better than another hole in the head. So, I think 9.3, a lot of people would be happy if the S&P gave them that year over year. So despite, what we hear, I think history can point us in the right direction.
Okay, thank you. Yvonne, if you could take that slide off, I appreciate that. So sort of continuing with the theme and the changing of the guard in Washington, D.C., Curious with Mihir and Roger, what are your thoughts with regard to, what we saw in business investment during 2020? What was the result of that? And given the landscape in DC, do you have any thoughts on 2021? There was a couple questions that I've been getting from the chat board. So Mihir, when you answer the question, one, there was just a sort of a question: do you see a change in the volume of M&A in anticipation that there might be a higher tax in 2022? So Mihir, I'll start with you if you want to provide your perspective on that, and we can also talk about the M&A activity.
Yeah, going back to the earlier question about the business investments in 2021, we certainly think that from a macro standpoint, you have a Fed which is very accommodating, and you also have, last week when you had sort of Janet Yellen being confirmed, I think one of the statements that she made, which was pretty interesting, was she said she is all in favor of acting big. So you're going to see a Treasury as well as a Fed which is a lot more open to keeping interest rates low, as well as providing a lot more stimulus into this economy. So from a macro standpoint, you're going to see a lot more investments coming into the market because capital is still pretty cheap. Having said that, the two things that I am concerned about is fundamentally the world has changed, and look, we are all doing this call by video today. We are not driving to XYZ conference room and doing so the world has fundamentally changed. So coming out of this pandemic, I think you're going to see business travel go down. I've seen projections as much as 50 to 60% decline in business travel. Will people still travel? Yes. Will the amount of travel and the spend on travel go down? Yes. So I think you're fundamentally, there are a number of industries which get impacted longer term, whether it's airlines, hotels, restaurants, you name it, every kind of people in and around who depend on business travel to survive. And I think those businesses are impacted quite dramatically. The other thing I would say is retail. Retail employs about 25 million people in this country. And given what has happened in the last kind of call it 10 months, retail as a sector has been dramatically impacted by COVID. And so it's going to take years for retail to recover from something like that. And so I would say generally I feel business investments will improve in 2021 compared to 2020. We do have a lower denominator, but I am a little bit worried about how long it's going to take for some of these sectors to recover, given the sort of the jolt that they've gone through, and it's not going to be a quick fix to fix some of these issues in terms of business travel and retail.
Roger, anything to add to Mihir's comments?
Yeah. So three things, just to kind of follow up on something Neil said. It's interesting. We're all sitting here watching and hanging on every word, the Biden administration says to try to get a clue as to what they might do. So let me just talk about three things. I've been paying quite a bit of attention to the tax people right now. And as we know, I think everybody here knows that the only way to get a tax change through is through the reconciliation process, which is possible. But like you said, it's not been a blue wave, and we have a sort of centrist Senate now. So I wouldn't expect to see huge changes, despite everything I heard during the campaign about completely rolling the world back to 4 years ago. However, I heard Janet Yellen say that, maybe now's not a good time to increase individual income taxes, given, in a recession, but corporate taxes could go up a little bit. So I think you'll see that. I've heard that from both sides of the aisle, not to 28%, but it might go to 25. on the corporate side, and that will have an impact on when you want to get your deal done, for sure. What's really likely to change, though, is how international transactions are taxed. Well, suffice it to say, I think we're going to go back to playing a lot of the same games we played 5 years ago by the time we're done, because there's a concern about building on what the Tax Cuts and Jobs Act did and making it just a little tougher to avoid or lower tax on offshore earnings. Just something you said, Yale, about carried interest, this is one example of what the last 4 years have been like in the tax world, especially the regulatory environment. We just recently got a set of regulations that were very taxpayer favorable on taxing carried interest. It's really hard to change regulations, oddly enough. It's harder to change regulations and statutes sometimes because the IRS has taken a position. But we know that the new administration is probably going to want to take a different view on a lot of these issues, and we've already had the midnight regulations, and then the executive orders trying to stop that as much as possible. So tax-wise, that's going to be, who knows, but I think you're right. I think it's just too centrist to Congress to want to do something very radical, except for international. SEC, securities rules, we've had such a friendly SEC these last few years. Gary Gensler is now the nominee to be the new SEC chairman. And I know Gary Gensler, he spoke to my class at Stanford Studies. We had what I would charitably call a spirited discussion about the role of regulation. And it is my view from that discussion that we're going to see a different SEC. And there's a new sheriff in town in that department, I would say. And thirdly, and you heard it here first, folks, this is the sleeper issue. If you read the Biden plan, we got AB5 here in California. It's the ride share, it's the gig economy bill that recharacterizes independent contractors as employees. That is a big issue with the Biden administration. And they say in their plan that they think AB5 is a great idea and there ought to be a national AB5. And in fact, there is a Senate bill that's already been introduced last September, making AB5 a federal law. That could be a very, very big change. It's going to affect my clients a lot because I do a lot of gig economy stuff. So those are my 3 points, and I'll turn it back to you, Mark.
No, I appreciate that, Roger. And we have about a few minutes left. There was sort of some feedback in the Q&A that we've been maybe a little bit rosy in our overall comments. So I'm just going to ask a question to the panel, and some of you have shared a little bit more about this. What do each one of you think the biggest risk is in 2021, and then balance that out with what really excites you? Yale, I'll start with you.
Well, I think probably the more obvious risk would be if the vaccine rollout and effectiveness does not meet expectations. I think that would have the most damaging effect both domestically and globally. What am I most excited about? Well, this is just personal note, and I think Roger mentioned this a little bit earlier. There is so much focus on the energy sector, and as we know, the energy sector, as it relates to the S&P, has just shrunk and shrunk and shrunk over the years. But with Tesla in our backyard now moving out, but Lucid, I mean, there's a lot of demand for clean energy, and I think that could be very transformative and very disruptive in a good way, because that has a ripple effect through every aspect of our economy and us as consumers. So I'm hopeful that we'll see continued progress along those lines.
Okay. Thanks, Yale. Roger? Same.
Well, let me take a little different. You say biggest risk. I'll tell you what I've been thinking a lot about. There is not a day that goes by anymore, not a day, that I don't counsel somebody on how to leave California. How to go to Miami's been hot recently, I guess, in more ways than one, but all the usual suspects. And that's always been a part of my practice, but now it's every day. And I'm starting to get a little worried about that when we say a little risk. I mean, it'd be nice if more of my clients would stay here. What I'm most excited about, I guess, I kind of went through the sectors that I think are going to do well. So yeah, I think energy is going to be big. Telehealth is the biggest opportunity, I think.
Yeah, thank you. Mihir, we'll end with you. And biggest risk and what most excites you about 2021?
I think the biggest risk is I'm concerned about if there is another sort of strain that hits the US, where if the vaccine doesn't work against that strain, that could be pretty damaging to the overall sort of recovery. We are counting on people getting vaccinated, a significant portion of the population getting vaccinated. So that's something I do worry about. I would echo Roger's comment about, as we have gone to this new world where people can be in front of a screen and work from anywhere, I'm seeing a number of people leave California, and that's certainly not going to be good for this economy, or at least the local Bay Area economy, because you're seeing a number of companies relocate. Oracle, Tesla, HP, etc. These are big companies that are relocating their headquarters, and what's changing is employees are moving to other places, and there's not a whole lot employers are doing about it, or they can do about it. And so I think you're going to start seeing, there's a book called The World is Flat. It's going to be America is Flat, right? I think you're going to start seeing people who are living in Denver who are going to be applying for jobs in Silicon Valley, and vice versa. And I think you're going to start seeing some of that. I think what I'm excited about, I think, is whenever you have these type of disruptions, innovation doesn't change. I think some of the best companies get created in environments like this. I mean, if you look back, a company like Airbnb got created in 2009 when we went through a recession, where people said they have an extra bedroom in their home and how can they monetize that, right? A company like Uber got started in a recession. So there is no shortage of innovation, and I think I'm excited that there will be companies that will innovate even in this market and will become big companies of tomorrow. So I think that's what I'm excited about, and I have a great opportunity to work with some of those entrepreneurs in trying to create solutions which ultimately improve people's lives. So I think overall I feel pretty positive, but I am concerned about a couple of things in the overall economy.
Yeah, thanks, Mihir. That was very uplifting. It definitely has proved to be the sort of cycle in the past. So we're expecting great things. So Mihir, Roger, Yale, thank you so much for participating today. ACG Silicon Valley, thanks for having us this evening. I do wish everybody a wonderful 2021. Stay safe, stay healthy, and hopefully by this time next year, when we're the sponsor again, we are in our Menlo Park office and we can clank our glass and get all the demons away. We'll be good. So with that, good evening, and thanks for all your time, and thanks for all the wonderful questions. Thank you.
Thank you. One more thing I want to say, I'm excited that this was a fantastic panel discussion, and we had so many attendees joining us tonight. What I'm worried about is that most of us are out of sparkling wine and chocolate now, and we still have a couple of hours to go. So on that note, enjoy your evening. Thank you to BNYML, and thank you to all the panelists. And we'll see everyone soon again at another event.
Thanks.
Bye.
Thank you.